Yeah, thank you, Matt. Jedi Options, we are going to talk about a bi-directional trade that is a volatility-based strategy. And the way I want to tee this up is you know that a bear is the opposite of a bull, right? If you're not bullish, maybe you're bearish. What is the opposite of neutral? Neutral does have an opposite, and we refer to it as bi-directional, right? And so when you think about when would you do a bi-directional trade, what's the context? What's the right situation? It would be a situation where you're the opposite of neutral. You're not expecting the market to settle down and do nothing. You're expecting it to perk up and do something. You just don't know which direction it's going to go, because if you did, or if you had a strong opinion, you would just go directional. So the idea with bi-directional is I expect big move up or down. I don't care. Either way, just give me a big move. And generally, see, this is one of the keys when it comes to a neutral or bi-directional. Generally, you have an opinion on option pricing. It's part direction, part option pricing. And generally, when you're neutral, right, you expect, well, neutrality, right? Sideways or a range. Okay. And options are maybe expensive, right? Maybe even overpriced, right? We're going to move less than expected. We will move less than expected, right? Bidirectional would be the opposite. So give me a big move up, big move down, and ideally options are cheaper, right? Options are cheap. If we're lucky, they're underpriced. And we think the market's going to move more than expected. Okay. In any situation, I mean, sometimes you have a catalyst, like in this case, a Fed announcement. I think that's going to be the catalyst to spark a big move up or down. And options aren't altogether that expensive right now, so it's not going to cost me much to build the trade. That would be the situation. So with the Fed announcement, with where the market's at, you might say, listen, I think either the Fed delivers and we get an upside breakout in the S&P and follow through, okay? In other words, I think it's going to break us out of the range, and maybe we get ideally like a multi-week move in one direction or the other. Or listen, we don't do well, and the market breaks down and you get continuation lower. If that's your opinion, that you're going to get one of those two outcomes, a bi-directional trade would make sense. Okay. And so what you're going to need to build that bi-directional trade is it's a combination of doing something bullish and something bearish simultaneously. I need a trade that makes money if the market goes up a bunch, but I also need a trade that makes money if the market goes down a bunch, because I don't know which outcome I'm going to get. So when you think about the family, the bidirectional family, you have something like a long straddle, right, where you buy an at-the-money call and put. Or you do a long strangle, where you buy an out-of-the-money call and put, okay? Or you do an inverted butterfly, where you are basically buying an at-the-money bull call and bear put. Or you do a debit condor, where you're buying an out-of-the-money bull call or bear put. They're all variations on the same thing. Bull trade, bear trade, just different strikes, slightly different structure. The way that I laid these out, essentially, the straddle is the most expensive. Okay. And then the debit condor is the least expensive. And it kind of follows that guideline there. So what I want to do is illustrate a debit condor, and we're going to do it on the S&P. I don't want to pick an individual stock here. I really just want to make a bet on the overall market, and the S&P is going to be the best proxy for that. But at $412, buying an at-the-money call, buying an at-the-money put is going to be pretty expensive. So I'm going to use the cheapest iteration here with the debit condor. One other thing I'll mention with respect to like the trade structure is when it comes to the time consideration, just know that if you do short term, like 1 week, okay, it's more aggressive. So you're going to win quicker, but you're going to lose quicker if you're wrong, okay? If you go longer term, like 1 month plus, that's more conservative, where you're going to win slower if you're right, but you lose slower as well. So you kind of have to decide where to strike that balance. These are all negative theta trades, okay? All of these lose money due to time decay, okay? So from a Greek perspective, they're all going to be theta negative, okay? But they are what we call gamma positive. It's a race between movements and time. I'm betting we get enough movement up or down to offset the time decay. Okay. So there is a situation here when you think about like worst case scenario. Okay. Worst case scenario is that the market doesn't move, that it yawns, that it takes a nap, and it doesn't do jack for the next week or two. Well, in that case, time decay is really eating away at the value of the calls that you purchased, and it's eating away at the value of the puts that you purchased, and you're just losing. What we want is we want the call or put to go deep in the money and accrue a lot of value due to the movement, enough to offset the time decay. That's it. That's the dynamic that's really driving the trade. So with the S&P, with that debit condor, what I'm going to do is I'm just going to buy like an out-of-the-money put and then sell a further out-of-the-money put, create a bear put spread. And then I'm going to buy an out-of-the-money call and sell a further out-of-the-money call to create a bull call spread, something like that. And then essentially I'm like, hey, Mr. Market, I need you either to go up here or down here, like now, like ASAP. Quicker you get there, the better. There's infinite variation with how like wide you can do this, how narrow, and it influences the cost. Okay, so what I'm going to do is I'm just going to come into SPY, and I'm going to go a little bit more, I don't know, let's go 2 weeks. Okay, let's go 2 weeks, 16 days out. Stock's at 412. What I'm going to do is I'm going to buy 30 delta, right? 30 delta put, 405. And I'm going to sell the 400 against it. I'm doing a $5 wide bear put spread here. Okay. Now, if I just did that, it's a bear trade. But again, I'm bi-directional. I don't know if it's going to go down. It might go up. So I need something on the bull side to neutralize this. And you can use different logic for where you put the strikes. I'm just going to anchor on the same delta. I'm going to buy a 30 delta call. Okay. And then that's 419. And then I'm going to sell $5 above it, 424. Okay. So what I have is a 405, 400 bear put, a 419, 424 bull call. Now it calls it an iron condor, and you can see it's a debit trade, which is why we often call it a debit condor. If you're really cool like Gino, you call it a debicon. Okay. If you look at the risk graph, you're going to see a risk graph where you want the stock to go up or down. I don't care. Just pick a direction. Okay. And in this case, my break even's around a little over 421 and 402. So I need a decent amount of movement here. You know, $10 up, $10 down. It's only a couple percent though. So if we could move, 3, 4, 5% up, 3, 4, 5% down, you're going to be profitable in this trade. You're going to be profitable. So last thing I'll say here is management. The worst case scenario, again, if we advance time, I actually want to go here. If we move time forward, you're going to see it gets worse and worse and worse and worse and worse. Okay. Most of your loss comes the last, week, the last few days, right? And so how do you manage this? Well, what I would do is I'd get the heck out if it doesn't move. I wouldn't ride it all the way to expiration. Okay. If it does move, this becomes a directional trade. Okay. And so what you don't want to do is let the market go up a bunch and get profitable, and then let it come all the way back down and lose a bunch of money. Or let the market drop a bunch such that this is profitable, and then let it come all the way back up such that you lose money. It's a bi-directional trade, but it becomes like one directional as soon as it picks a direction. So you got to kind of manage it like a bullish trade. If we rip and go higher, you're trying to let it ride as long as it's rising. If it starts to come back at some point, you want to exit. And then the inverse of that, if we drop, it keeps dropping, great. But if it pivots and starts to come back up, you want to get out. Okay. You could use a trailing stop or put a stop under a candle high or low, something like that. But you don't want to overstay your welcome. That is one common mistake I see with this is people will throw it on, they'll make a profit, market will come back, and then they give it all back. You don't want to do that. You don't want to do that. But there you go. Bi-directional, debit con, when you think vol is low, when you expect a big move up or down, that's where these kind of strategies come into play.